Somebody went looking for $100 billion this week, and they went to a lot of trouble to make sure it never showed up on their balance sheet. Here's the part that should get your attention. The stock market saw that announcement and bought. The credit market saw the exact same announcement and charged the highest price it has ever charged to insure that company's debt. Two markets, one set of facts, completely opposite conclusions. Only one of them is going to turn out to be right, and I want to show you why I think it's the boring one. Let's start with the story you've been told, because it's a good one and most of it is true. The artificial intelligence buildout is the biggest capital spending program in corporate history, and the companies doing it are the richest companies that have ever existed. Microsoft, Alphabet, Amazon, Meta, Nvidia. Names sitting on cash piles bigger than most national economies. So when people worry about the spending, the answer has always been the same. Relax. They're paying for it out of pocket. It's their money. If they're wrong, they eat it. And for about 2 years, that answer was basically correct. And then this month, it changed. Quietly. Not with a crash, not with a warning, but with a press release that almost nobody read all the way to the end. August 10th, Nvidia announces it's partnering with 6 of the biggest money managers on the planet: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, KKR. The goal, in Nvidia's own words, is to mobilize more than $500 billion of third-party capital to build out artificial intelligence infrastructure. Now read the next part slowly, because this is the whole episode. The arrangement is designed to let outside investors fund the build-out without adding directly to Nvidia's balance sheet. That's not a leak. That's not an accusation. That is the company describing its own structure on its own website, and it means the money paying for this is no longer their money. And days later, Broadcom went further. Bloomberg reported the company negotiating roughly $60 billion of senior secured debt, routed through something called special purpose vehicles, plus a junior slice of about $30 billion on top, up to $100 billion. If it closes at that size, it would be the largest financing of its kind ever funded. And the purpose is very specific. Buy custom artificial intelligence chips, then lease them to customers. One of the named customers is Anthropic. 2 of the firms in talks to fund it, Blackstone and Apollo, are the same names that showed up in the Nvidia deal 10 days earlier. So this isn't one company getting creative. It's a template. Okay, what is a special purpose vehicle in plain English? You create a separate legal company. That company borrows the money. That company buys the asset. And because it's technically a different company, the debt sits on its books instead of yours. You get the chips. Somebody else's balance sheet gets the loan. It is completely legal, it is extremely common, and I want to be really clear, it is not automatically sinister. Airlines finance planes this way. Utilities finance power plants this way. When the asset produces steady, predictable cash for 20 years, this is genuinely the right tool. But notice what it does and does not do. It moves where the debt is recorded. It does not move the risk. The risk goes somewhere. It always goes somewhere. So here's the question that actually matters. If the risk didn't disappear, where did it go? And the answer is that somebody, somewhere, put a price on it within hours. There's a market whose entire job is to answer one question. Will this debt get paid back? It's called the credit default swap market, and a spread is just what it costs to insure somebody else's borrowing. Higher number, more worry. When the Broadcom financing hit the wire, that spread jumped to 122 basis points, the highest in the company's history. And I want you to notice what it did not react to. Not an earnings miss, not a lost contract, not a downgrade. It repriced on the announcement of a structure. The people whose money is on the line looked at $100 billion routed through vehicles nobody has to consolidate, and they decided that was worth paying more to insure against. That same afternoon, the Nasdaq closed higher. Now let me give you the honest counterargument, because if I skip this, I'm just selling you fear, and there's plenty of that available for free. 122 basis points is not a crisis. It is not close to a crisis. Broadcom is a profitable company with real customers and real contracts. Morgan Stanley, which has been the loudest voice about this financing gap, still models returns on invested capital above 25% on this spending. And hyperscaler credit spreads, which widened over the summer, have actually narrowed sharply over the past 2 weeks. So the bulls have a case, and the case is simple. If the returns are that good, borrowing to capture them is not reckless. It's rational. The demand for artificial intelligence compute is not imaginary. I've seen nothing that suggests it is. Except, here's the number that keeps me interested. Morgan Stanley expects capital spending at the 4 biggest cloud companies to rise 57% in 2027. And over that same stretch, the bank's own free cash flow estimates for those same 4 companies keep getting revised down. Spending going up steeply. Cash available to fund it going down. The bank has a name for the space in between, and it sizes it near $1.5 trillion. That gap doesn't get closed by optimism. It gets closed by financing, which is exactly what we just watched 2 of the most important companies in the world go out and arrange, in structures specifically built so the borrowing lands somewhere other than their own books. Here's the read, and it's narrower than the headlines you'll see about this. The risk in artificial intelligence right now is probably not demand risk, it's timing risk. Chips get financed today. Interest comes due on a schedule. Revenue arrives when customers are ready, and customers are never on your schedule. As long as those two lines stay close together, this structure is elegant and everybody wins. If they drift apart, losses don't show up on the balance sheet you were watching. They show up in a vehicle you'd never heard of, held by an investor you can't see, and you find out afterwards. That's not a prediction of disaster. It's a statement about where you should be looking, and almost nobody is looking there. Watch whether Broadcom's junior slice actually clears, and at what price. That is the honest test of whether this template holds. Because that's what actually happened this month. Not a bubble popping, not a crash, something much quieter and honestly more interesting. The biggest spending program in corporate history quietly stopped being paid for out of pocket, and the only market that reacted was the one that gets paid to be pessimistic. The question isn't whether the demand is real. It obviously is. The question is this: if the returns are as good as everyone says, why does so much of the money have to arrive through a vehicle nobody has to put on their books? Sit with that one. I'm Frankie. This is research and education, never advice. The asymmetric signal. One contrarian read a day. Subscribe.